If you're looking for a safer way to grow your money than equities, but want better returns than a traditional fixed deposit, debt mutual funds could be the perfect solution for you. But before you jump in, there are critical things you need to know to make informed decisions. In this video, we'll break down everything about debt mutual funds, what they are, how they work, the risks involved, and who should invest in them. By the end, you'll have a clear understanding of whether debt funds align with your financial goals. So let's dive in. What is a debt mutual fund? A debt mutual fund is a type of mutual fund that primarily invests in fixed income securities like bonds, treasury bills, government securities, and corporate debt instruments. Unlike equity funds, which invest in stocks, debt funds focus on generating steady returns through interest income while preserving capital. They are ideal for conservative investors or those looking for short to medium-term investment options with relatively lower risk. Debt funds come in various categories, such as liquid funds, short-term funds, gilt funds, and corporate bond funds, each catering to different risk appetites and investment horizons. What is a bond? To understand debt funds, you must first understand bonds. A bond is essentially a loan you give to an entity, be it the government or a corporation, in exchange for periodic interest payments and the return of the principal amount at. When you invest in a debt mutual fund, the fund manager pools money from multiple investors and allocates it across different bonds based on the fund's objective. The performance of a debt fund depends on factors like interest rate movements, credit quality of the bonds, and the duration of the portfolio. Problems that debt funds solve. Debt mutual funds address several pain points for investors. First, they offer better liquidity than fixed deposits. FDs. While FDs lock in your money for a fixed tenure, most debt funds allow withdrawals within 1-3 business days. Second, they provide tax efficiency. If you hold debt funds for more than 3 years, your gains are taxed at 20% with indexation benefits, which can significantly reduce your tax liability compared to FDs, where interest is taxed as per your income slab. Third, debt funds can offer higher post-tax returns than FDs, especially in a falling interest rate environment. Lastly, they provide diversification by investing across multiple bonds, reducing the risk of default from a single issuer. Differences between fixed deposits and debt funds. Many Indians rely on FDs for safety, but debt funds can be a smarter alternative in many cases. The key differences lie in returns, liquidity, taxation, and risk. FDs offer fixed, guaranteed returns, while debt funds provide market-linked returns that can be higher or lower depending on interest rate movements. FDs have a lock-in period, whereas debt funds, except for close-ended ones, allow redemption anytime. Tax-wise, FD interest is fully taxable, while debt funds held for over 3 years benefit from indexation. However, debt funds carry slightly higher risk due to market fluctuations, whereas FDs are insured up to 5 lakhs per bank. The choice depends on your risk tolerance, investment horizon, and tax bracket. Who should invest in debt funds? Debt funds are suitable for a wide range of investors. If you're a conservative investor who wants stable returns with lower risk than equities, debt funds are a great fit. They're also ideal for short to medium-term goals, 1-5 years, like saving for a vacation, down payment, or emergency fund. Retirees looking for regular income can opt for monthly income plans, MIPS that invest partly in debt. Even aggressive investors can use debt funds to balance their portfolio and reduce overall volatility. However, if you have an ultra-low risk appetite or need absolute capital protection, FDs might still be better for you. What are the risks? While debt funds are safer than equities, they aren't risk-free. The primary risks include interest rate risk. When interest rates rise, bond prices fall, leading to temporary losses in debt funds. Longer duration funds are more sensitive to this. Credit risk. If a bond issuer defaults, the fund's NAV can drop. Funds investing in lower-rated bonds offer higher yields but carry higher default risk. Liquidity risk. Some bonds may be hard to sell quickly, impacting redemption. Reinvestment risk. Falling interest rates can lead to lower returns when bonds mature. To mitigate these, choose funds based on your risk tolerance, liquid or gilt funds for safety, corporate bond funds for higher returns. Why you should invest. Debt funds offer a balanced mix of safety, returns, and tax efficiency. They're a great way to park your emergency fund via liquid funds, save for short-term goals, or diversify your portfolio. With RBI likely to cut rates in the future, locking in higher yields now can be beneficial. Plus, the indexation benefit makes them tax efficient for long-term holdings. By understanding your financial goals and risk appetite, you can select the right debt fund category to optimize returns while minimizing risk.
Conclusion. Debt Mutual funds are a powerful tool in your investment toolkit, but they require careful selection based on your goals and risk tolerance. Whether you're looking for an FD alternative, a parking space for short-term funds, or a way to balance your portfolio, debt funds can offer compelling benefits. Always check the fund's portfolio, credit quality, and expense ratio before investing. If you found this video helpful, don't forget to like, share, and subscribe for more such insights.